Good evening and welcome to my next update of the war on the markets. Today's markets were reflective, I think, of the slight easing in the geopolitical situation. While Iran came out with strongly and said that they had kind of come up with a proposal by which Hormuz could be opened, though US has termed it as rubbish, I think that we have to discount a lot of the talk. It is a fact that a real sincere attempt is being made by both sides to come to a solution. Openly, they will use this kind of fake narratives or a thing to do that, but market senses that the war is getting closer to an end, and this you can see from the way oil prices are reacting, right? Today, oil traded in a range of between 95 to 99, and as I speak, post market hours, it has in fact eased to about the 94 to 95 levels. So clearly, from this, you can read that oil is not panicking and going to 110, 120 behind any of these kind of strong rebuttals. So I'm confident that there is some talk going on. It may take a little more time, but we are closer to the end, is pretty clear. So does this then impact the FII flows? Well, FII accounts have come down dramatically from 1.2 lakh crores in the month of March to 60, 70,000 crores in the month of April to just about 26,000 crores as of today. Tomorrow market is a holiday, so it leaves probably another couple of days. So I doubt that the selling is going to be more than 30,000 crores. So clearly it's coming at half the previous month. So the read is that with the situation not getting so much worse, and a lot of the news at oil at 95, I think by and large is in the price of various stocks, and supported by the fact that the earning season has been fairly good, though as I've mentioned it earlier, this doesn't mean that the next earning quarter will be good. In fact, it could mean next quarter will be much worse, but FIs I'm sure will look beyond a temporary war impacted quarter of Q1 into the rest of the year if the thing stabilizes. What is not, however, clear is that even if there is a solution to the war, will oil prices correct much further down from this? Which I think that the consensus emerging is that it will take a long time for oil to come back to those 70 levels. From 85 to 90. So there's not that much upside in terms of oil going from a 95 to a 90 or 85 left. So I don't expect FIBF to change very dramatically towards India. So what they did today was again like yesterday, sell about 1,000 odd crores, 1,200 crores in the Indian markets. I think this is a feature which is going to continue for some time unless there is some other strong action. And probably what has also contributed to the decrease in FI selling is that the government has started passing on the rate hikes. So to that extent, the fiscal pressure will be lesser. So yes, the inflation will come in, but in any case, inflation today is on a trajectory across the world is a rising inflation. So India will be also a part of that. So DIS, however, with the earnings season coming very much clearly to an end, have now got clarity on terms of a medium-term outlook on sectors. Of course, they're also reacting to the geopolitics every day in terms of what to buy and sell. So about almost 4,000 crores, which is almost like 3 to 4 times of what FI sold today they bought. And this trend has been there through this month. So 26,000 crores is the FI selling, 57,000 crores has been the DI buying. So clearly DI buying has stepped up this month and is cushioning the market. So as a result, if you look at two things then, what did the retailers do today? I think the retailers were a bit quieter today. The reason I say is that like yesterday, advance decline was 50-50. Today was slightly in favor of advances. But if you look at the index performance, large caps were flat. Mid caps and small caps were slightly better, but micro caps were also almost slightly negative. So when you see the advance decline ratio is fairly equal and the micro caps are slightly under pressure, it means that it was a more mutual fund action and insurance action that held up the mid and small cap. Whereas with the retail participation, I would expect a little better performance from the micro caps, which was not the case today, right? Now, the easing oil tensions naturally led to an oil, as I said, in a range between 94 to 99 today, but the currency also slightly weakened to 95.69. Still much lower than the 96.87, which was the recent peak. So, and volatility index was down 7% today at below 15. So clearly that's a sign of easing tensions. Of course, the expiry of the Nifty yesterday, and since tomorrow Thursday is closed, the Sensex related expiries also should have got done today. those have probably contributed in terms of what the option holders and everybody is exercising has created a reduction in volatility yesterday also, remember, and today. So GIFT Nifty, however, as we speak today, is about 0.5% down. So that's, I wouldn't read too much into that because there's a long holiday. Of tomorrow's a holiday. Markets will reopen only the day after tomorrow, and hence there is a bit of nervousness around the geopolitics that will continue. But when the markets reopen after a day's break, I don't expect very much difference because the way things are going, talks are going on, but I don't expect an immediate resolution to the war situation. It is closer to a resolution, but I don't see an immediate Goldilocks kind of immediately abracadabra, it's now solved kind of situation. It's going to be hard fought and negotiations will continue for some time. But I get a sense that it will not get so much worse also from a point of view that both sides are now a bit tired of the war and seeking a solution. That's a broader read, I would say. So to that extent, I feel that with clarity around the earnings season and clearly DIS playing their cards, today's sectoral allocation, if you see, the sectors got affected were largely the large cap oriented sectors, which is IT, FMCG, and the private banks. So that's why the large cap index was flat today, right? And what went up was all the rate sensitives again, like yesterday. I think consumer durables, auto, realty, these were the things which are gone up today. And a little bit of oil and gas thing. Energy with refiners was down, but the oil and gas with producers was up. So expect this pattern to continue. Hence, in the continuance of the pattern, there's no need for investors who've been following my advice to make any changes to it. Right? People are asking me, sir, if they are saying that the war is getting closer to end, should we now step up and switch into lump sums or increase the allocation? Say increase if I've been recommending a 1% a day. You want to increase it to 1.25, 1.5 fully, you're okay to do that. But I would still not suggest you to either put lump sums in or to make strong sectoral calls in yet, right? So with that, let me sign off for today and look forward to day after tomorrow with my next War and Markets update.